The cost of living has been exploding over the past 4 years, and people are now looking for the cheapest and the best place to shop. It is why today we'll take a look at one of the largest retailers in Canada and we'll make a full stock analysis on the company Dollarama with the ticker DOL. After checking out what is their business model, so how are they able to generate their income, we'll make a quick fundamental analysis followed by price prediction to determine if the stock is currently under or overvalued right now. Without further ado, let's dive deep down into this company. Dollarama was initially founded in 1992 in a small Quebec town in Canada which is called Matane. The objective behind this company was to offer their different customers a bunch of different products for $1 or less, and over the last couple of decades we've seen that this business model has worked pretty well. In fact, we now count over 1,400 stores of Dollarama in Canada, in the US, and in different Latin America countries. This main expansion, especially in the south of the country, came mainly in 2019 with the acquisition of a 50.1% stake in the Dollarcity company. This happened following a 6-year commercial partnership where at the end of 2019 there were over 500 Dollarcity shops in South America. Plus, Dollarcity on their side has the objective to increase their number of stores up to 600 stores by 2029, where we know that they are currently well established in 3 big countries which are Guatemala, El Salvador, and Colombia. Concerning the Canadian market, Dollarama has been named in 2009 the largest retailers in the country, selling items of $5 or less. This means that obviously the company isn't selling any types of expensive items to their customers, but they're still offering a wide variety of products going from foods to clothes, passing by furniture and sport goods. In 2023, all of these products have helped Dollarama to generate close to $6 billion of revenue with an excellent profit margin of more than 15%. In fact, one of the great things that have helped Dollarama over the years to generate some excellent profitability is their super low operational cost. While a certain portion of the products of Dollarama comes from different places around the world, a big portion of it will come directly from China at some super low cost. Knowing that China is currently one of the best manufacturers to have different products at some low cost, this has greatly helped Dollarama to continuously offer some super low and competitive price for their different customers despite the growing inflation. Nevertheless, over the past couple of years, we've seen that their whole mission of the 90s to sell different products for less than $1 is far behind them, where they are now selling products up to $5 right now. Another important factor that help them to keep some low costs is the fact that they make sure to keep some low staff in their different stores that are not necessarily paid at a nice salary. But from an investor point of view, their latest earnings report have been particularly interesting. Indeed, in their latest earnings report, we've seen that they've been able to increase year over year their total quarterly revenue by over 9%, where we've seen also a boom of 20% of progression in their net earnings. This growth has also been reflected in the total opening of new stores in the latest quarter, where Dollarama has opened 18 new stores. Over the years, Dollarama's strategic initiatives have played an important and crucial role in its stock price appreciation, and it's set to continue the same for the future. In fact, the company has the objective to have over 2,000 stores opened by 2031 in Canada and over 1,050 Dollarcity shops opened by 2031. The incredible expansion that the company has been able to do in the past and that is expected to continue for the future is one of the main reasons why the stock's value has appreciated of more than 40% year to date. And this is also due to the fact that they have an extremely relevant business model for the people, even for the future, because in fact people have always been looking for the cheapest options to buy their essential needs, and it will continue and it might amplify in the future, especially with the current global economic conditions. But now let's see what the valuation measures are telling us about the true intrinsic value of this company. First, we can notice that with a market cap of less than $40 billion right now, Dollarama is quite less known compared to other big giant retailers such as Walmart or Target. Add to this this with a current price to earnings ratio of close to 40, it might be showing that this stock with this indicator would currently be overvalued. However, what is pretty interesting about the company is its incredible profit margin and operating margin that they've been able to achieve over the last 12 months, as well as a gigantic return on equity during the same period of over 300%. Over the last 12 months, as we've seen earlier, the company has been able to generate close to $6 billion of revenue, with some great revenue growth in their latest quarterly revenue of close to 9% and some great quarterly earnings growth of about 20%. However, a more worrying point about the company is the fact that they only sit on about $300 million of cash compared to a debt of over $4.5 billion, where we can see that they have a tremendously high debt to equity ratio of over 1000%. Nevertheless, when we analyze the volatility of the company represented by the beta on a 5-year period, we can see that Dollarama is about 2 times less volatile than the overall market. However, over the last 52 weeks, we can see that the company has gained way more value than the overall market, with some gain of close to 60% compared to 28% for the overall market. Then an important part of the equation when we analyze great dividend growth company is the dividend that they are offering, and in their case, they are offering a super low dividend of less than 1%. But the great and interesting thing about it is that they have a super low payout ratio of less than 10%, meaning that at the moment they are mainly reinvesting all the net earnings that they receive into the company to make it grow even faster. But in the future, they'll definitely be able to increase this low dividend that they are currently offering. It is also interesting to see that over the last 4 years, we can see that they've been able to continuously increase their total revenue despite all the COVID lockdown, and this great trend has been reflected in the great overall net income progression during this period that has always been positive. But now, to determine what is the true intrinsic value of this company, as always, we'll be using many different evaluation models to help us with this task. Starting out as always with the Peter Lynch valuation model, which is a simple formula where you add the future growth of the earnings per share with the dividend yield and that you divide with the price to earnings ratio. And since the company currently has a super low dividend yield with a super high price to earnings ratio, it means that the results are showing that this stock would currently be overvalued. Now for the second model, which is a dividend discounted model, we'll use the past dividend payout of this company to find what is its project intrinsic value. However, since they are not offering some high dividend at the moment and with the super low average growth rate of less than 4%, it means that the company's value would currently be quite overvalued at the moment. Now for the third model, which is the discounted cash flow model, where we will simply discount all the future free cash flow that are predicted for this company to find its true value. We'll start by finding what is the cost of debt, the cost of equity, the cost of debt and equity, and our weighted average cost of capital. And then we can simply find what is our future free cash flow, and then we find our intrinsic value of less than $60 per share, meaning that once again this stock would be quite overvalued at the moment. And finally, with our two last methods, which are the Graham's original value formula and the Graham's revised value formula, we find that with the first model we are pretty much at the same intrinsic value compared to our current price, but with our second model, we find that once again, this stock would be quite overvalued right now. As you've been able to see in this video, according to the different evaluation models, this stock would currently be quite overvalued right now. This results mainly come from the fact that the company has rapidly appreciated in value over the past couple of years compared to their total earnings progression. It is why with a price to earnings ratio of 30 right now, it might be pretty expensive for certain investors. Nevertheless, what is truly interesting about the company is the potential of growth that they still have for the future. In fact, in my opinion, it is currently one of the best dividend growth Canadian stocks that are currently available with a super low dividend payout ratio of less than 10% right now. This means that after their objective to continue their massive expansion by 2031, they might be tempted to reward their different investors with bigger and more important dividends. But keep in mind that they also might be tempted to increase their dividends in the near future to encourage more people to invest in them. In any ways, with our great business model to offer the cheapest products possible at a wide range of different families, this is definitely a company that I will personally keep an eye on for the future. However, on your side, if you're currently looking for other different picks to add on your watch list for the rest of 2024, well, check out the video that's going to be right over here, and I will see you soon. Peace.